policy recommendations and some views may differ. It is a classical balance of payment crisis, I will argue, but of course not with everything being equal. I will try to point out the differences. I speak about the bubble, this crisis, the two options for Europe, and come to my conclusions. So the bubble which we had in Europe resulted from the interest convergence. You have seen that with the announcement of the euro, all the interest rates converged. They were very, very different. Greece had interest rates of 25% and now again. And Italy had, and Spain and Portugal had 5 percentage points more interest than Germany. Germany is always at the lower end of the spectrum. And you see that already the Madrid summit in December 1995, which specified the date when the physical euro would come, caused the interest convergence for obvious reasons. And that implied that in the southern countries, cheap money was available. They borrowed in Greece to pop up the government sector. In Ireland and Spain, it was the construction sector that absorbed foreign credit. In the end, it didn't matter. In Greece, the government employees built homes, and in Spain, the construction workers paid taxes, so the respective other sector was automatically in the game. The big bubble, which was inflationary, took place and created huge current account deficits in these countries, which then had to be financed. But you see, obviously, it was only a temporary phase of history which the euro, during which the euro was able to bring about an interest convergence. These countries couldn't pay back their debt before they came into the euro. They can't do it now. In the meantime, we had the illusion that they would. Here you see the price changes that took place since the Madrid summit until Lehman. Obviously, there was an enormous change in relative prices, Germany being at the lower end, as you see here, the others inflated a lot. These are the GDP deflators. And they imply that the GEEPS countries with two I's, Italy, appreciated by exactly 30% relative to their trading partners in the eurozone, while Germany depreciated by 22%. These are astronomical numbers. And that is the problem. The competitiveness disappeared. The prices are somewhere in the sky. Current account deficits, no one wants to finance them any longer. In order to rebalance, we need a realignment of prices, but that's easier said than done in the currency. We have to rewind the clock, but the clock likes to go only in one direction. What Brookman said it's completely impossible. Well, he has a point. Let's look to the real exchange rates defined as GDP deflators relative to the rest of the eurozone. Here you see the Greek relative price level. Lehman is equal to 100. They appreciated during the crisis. Okay, they had a VAT increase, but the appreciation was even more than that. Here you see Italy, no sign of a real depreciation whatsoever. Portugal, France, Spain, nothing. You may have seen the recent study of Goldman Sachs, according to which Spain would have to depreciate by 20%, Portugal by 35%, Greece by 30%, Italy by 10–15% in order to find a new equilibrium. This is simply not happening. But there's one country where it is different. And I show you this because Paul Krugman showed another graph yesterday, so I thought I briefly spend a moment on this graph. You see that Ireland did depreciate. The curve he shows about the wage per hour doesn't really reflect it because there was a productivity increase. So Ireland had an enormous real depreciation by 15% since 2006. Why Ireland and why not the others? Well, first of all, they are more flexible. They always wanted to be American. But the singled out. There was no crisis perception, no rescue programs, no particular programs of the ECB. They had to help themselves, and so they cut their prices. While the others, when they came into trouble, jointly organized auxiliary programs through the ECB, through the EU, which made it unnecessary to have realignment of prices. The bubble burst when the American crisis swept over in the summer of 2007 to Europe, and in particular with Lehman a year later. The capital markets were no longer willing to finance these countries. The question is, who financed them? The answer is the ECB. So here we come to the balance of payment crisis. The paper to which I allude, we had in the first version last June. Many of you have seen that, and this is the final version that we'll be going to print, which is lying here somewhere, with the most recent data. To fix ideas, let me try to help you with this. This is euro. These are payment flows in all directions for buying goods, for credit contracts, for buying assets, anything. And a balance of payment equilibrium in the particular countries is such that there are no net flows of money across the borders. Here I showed in green the credit flowing, the money flowing in terms of credit from the core to the periphery. And yellow is the payments for buying goods in net terms in the core. These things were all balancing out until 2007. But then, all of a sudden, there was a stop. The capital didn't flow anymore, and the green arrows are missing. Still, they want to buy their Volkswagens. So, the outflowing money is still there, but there is no money flowing in. And even worse, there is an outright capital flight insofar as the banks of Central Europe not only stop financing the current account deficits, but withdraw their existing stocks of credit, given that they have all short-term maturity, they just didn't revolve the credit. And so the periphery countries even had to send more money to the center to redeem their debt. Now, the net amount of money that through this process was flowing to the center is what is measured by the target balances. Exactly that. It's the money that electronically was flowing across the borders. If I speak of money flows, money printing, shredding, I always mean electronic things. We don't have statistics about physical money flows. And the target balances are accumulated balance of payment imbalances. It's exactly the same thing which we know from the textbook. It is reported in the balance sheets because if a payment order comes, say, from Greece to Germany, then the Bundesbank has to credit the amount in favor of the recipient of the money. It gives a credit by carrying out this payment. And in exchange, it gets a claim against the ECB system. And the central bank, from where the money is sent, gets a liability which is shown in its balance sheet. So these things were hidden in the balance sheets, and finding them and making a systematic database out of it was quite a cumbersome process, I can tell you. There is, up to this date, as far as I know, in the ECB, not yet a database on the target balances. Maybe it is changing, but in autumn this was what was said. So now comes the next stage of the story. The money cannot simply flow out of these countries, then the stock of money in circulation dwindles and they don't have enough for transactions, so they have to reprint the money. And actually it was exactly as much reprinted as was flowing out, as we show in the paper. So the target balances not only measure the net outflow of money, but also the money being reprinted and being given to the respective economies in terms of refinancing credit. So it's the extra refinancing credit beyond the normal refinancing credit and money printing for the internal circulation within these economies. Why was it so easy to reprint the money which was flowing out? The Deutsche Bank was not giving credit to a Greek bank anymore, so the customer was not able to buy the Volkswagen with borrowed money from the Deutsche Bank. Well, the money came from the ECB, from the printing press instead. Why was it so easy to print the money? After all, you would say we have a currency union with lots of national central banks, that they have formed even a center called ECB, and everyone has a printing press in the basement. Small country, Greece, has a small printing press. Big country, Germany, has a big printing press. Somehow the printing is in proportion to the size of the country. So it can't be that you just reprint the money which is flowing out. But it is possible. It is possible. There are no restrictions except the one that that the banks have to offer collateral, of course, when they want to have refinancing credit. And a small country has less collateral than a big country. That's the only thing which proportions the amount of money to the size of the country. But this system of portioning the money has been undercut by the ECB by regularly reducing the quality requirements for collateral. Until Lehman, it was A minus, then it was BBB minus, then there were, they said 2 dates when they would be terminating this policy, but they never terminated it. Then in addition, the rating requirement was waived for government bonds of Greece, Portugal, and Ireland, regardless of what the the rating agencies said. When they said these are trash bonds, doesn't matter, you could use them for refinancing operations. Then there were the ELA credit, was the ELA credit emergency liquidity assistance, where a national central bank could give out the credit even without refinance, without collateral, or if with collateral according to its own decision, because it was made liable. Usually if something goes wrong, all participating central banks share the loss, but in this case it's only the national central bank. And then there were non-traded ABS papers created by the commercial banks where they put everything in which they found. These are the sausages which you very well know from the American system. You don't really know and don't want to know what kinds of ingredients went into the sausages. In the case of Portugal, one has found an asset bond with a maturity date at the 31st of December 9,999. And as far as I know, the rate of interest of 0. This is the reason why Jens Weidmann, the president of the Bundesbank, has written a letter to Mario Draghi complaining about this insufficient securitization policy. And now an additional 500 billion program is prepared where the banks can even offer their credit titles against private company as collateral. Now let's look to the core. The money was flowing to the core countries. What happened there? Was the stock of money circulating exploding as it should have been? No, because the money went into the shredding machine. The banks didn't need the extra liquidity, of course. They had the liquidity, they tried to offer it. In Germany, they offered it to the construction sector, and we have a building boom because of that. We have a very low interest rate. But as you know, if you offer the money, it doesn't disappear. It just goes from one account to the other one. So this extra liquidity so it disappears. This is just like the Bretton Woods system operated at the time when we had fixed exchange rates. The Fed was printing money excessively. The money was used to buy goods and assets in Europe. The European sellers brought the dollars to their respective national central banks, converted them into domestic currency, and we in Germany at the time had quote-unquote dollar Deutschmarks in circulation, which crowded out the refinancing Deutschmarks, which were the normal Deutschmarks there. So the refinancing credit shrunk while America expanded its refinancing credit at the time. It's exactly the same phenomenon that we have in Europe. At the time, we were saying that Europe finances the Vietnam War. One tolerated that. You know, one guy didn't tolerate it, Charles de Gaulle, and he sent a warship to America to get the gold back. He succeeded, and then America said, not another time. That was the end of the Bretton Woods system. This is the only difference. We can't send a warship to Greece to ask the Greece to give us gold in exchange. But the process goes very far. By the end of last year, 93% of the monetary base of the eurozone was created in the 5 crisis countries. And I guess by now it's more than 100%. I don't have the numbers. All the money in the eurozone comes from Greece, Ireland, Italy, Portugal, and Spain. It is a process of converting the savings. We have, Germans have savings. They bring their money to their banks, hope that the banks have own some marketable assets in exchange, but they don't. Increasingly, they have all just claims against the Bundesbank, and the Bundesbank has a claim against the ECB system. And this, for an average member of the active population, is 15,000 euros already. And in the Netherlands, it's 17,000 euros, and in Finland, it's 21,000 euros. It's very easy to speak about rescue operations when you're sitting in America and speak about other people's money. But when you see it from the perspective of these countries, it is a very dubious operation. Here are the numbers. This is how the target balances, namely the target debt of the JIPs throughout Italy increased. And you see it's clearly here the breakdown of the interbanking market in 2007, which made this thing increase. And this is the corresponding German target claim. The same numbers, but with another opposite sign. And it has increased to 616 billion euros by March. Here you see the eurozone in explosion, in slow motion. A breakdown by more countries you see here by the end of last year. You see that like Germany, the Netherlands, Luxembourg, and Finland are creditor countries, and among the debtor countries there's also France. France will be a new topic because the French target debt is rising rapidly. They published with a delay, a much longer delay than all others. We have to wait until June to have the March figures. We will have a surprise. This is for the JIPS countries, 655 billion. For all countries together for which we have the data today, it's already 900 billion target debt today. This number is by the end of last year. We are 3 months further ahead. $900 billion target debt, euro target debt. What does the target finance have to do with the current accounts? Well, there is of course a budget-constrained for an economy, the current account is usually financed through the capital account. If it is not financed through the capital account, you have to give money away, and you can reprint that money. So the target debt, the increment in the target debt, plus the capital import, by definition, is equal to the current account. And the current account, therefore, has to be financed either with target debt or with normal, usual capital imports. Let's include rescue programs. Here you see for the different countries how it worked. This is the target curve for Greece, as you know it from the previous graph, starting in 2007. And the blue curve shows the accumulated current account deficit of Greece starting by the 1st of January 2008, and the starting point was put at the same level where the yellow curve is at that point in time. So that the accumulated numbers from the beginning of the crisis you can see here. And what you see is basically they end up after 4 years at the same point, meaning that over these 4 years, nearly 100% of the accumulated current account deficit of Greece has been financed through the printing press. In the public, often one has the impression the crisis is a current, new, intense phenomenon starting, let's say, in May 2010. In fact, the rescue operations began much earlier through the ECB system. Greece has been cut off from the capital market since the beginning of 2008. We are in the 5th year of entirely financing that country. The aggregate credit and haircut bill, which Greece has received up to this day, is nearly exactly 500 billion euros, while the national income of Greece is 180 billion euros. Some people say we need to have the Marshall Plan for Greece. If one calculates the percentages of the Marshall Plan, Greece would have been entitled to receive 4 billion euros, not 500 billion euros. This is Portugal. Very similar, you see the difference was Portugal did have some normal capital import here until 2009, but then in the second half of 2009 there was a capital flight, and all the capital that had come before disappeared again, so that over the 4 years, basically it's the same story as in Greece. Entire financing of the current account deficit with target money, with reprinted money. Ireland, very different. Small current account deficit, huge capital flight, obviously, as you see here. Spain, until last summer, it seemed okay, only a quarter of the current account deficit was target financed, but then began the capital flight from Spain in the summer. And it is so huge that even Spain now, if we aggregate over these 4 years, has no surplus of private capital inflows. And finally, the same story for Italy. Here it's even worse. The capital flight was so enormous that all the capital that had come since the beginning of the crisis have disappeared, and even more. Germany received for its current account surplus, by the way, no marketable assets, but only money printed elsewhere. Not a single marketable asset was acquired for the current account surplus, which we had with the other countries of the eurozone over the last 4 years. Not a single euro. Why is why is the target credit the problem? First, these are fiscal rescue operations, circumventing the parliaments. The stocks of money balances don't change, neither in the countries nor in the aggregate. Eurobonds will necessarily follow, because there's only one way to bring the money back. You have to collect We have a uniform interest policy of the ECB, despite the different credit risks, which distorts the markets. Basically, since we are way beyond a sudden crisis procedure, but in a normal, long-run situation already, I would say we are having now, it's a little bit provocative, a central planning agency that runs the capital market in Europe. And of course, the printing press chases the interbank credit away and causes the capital flight. The money which you pump into these economies either maintains the current account or it flows out again immediately. There is no third possibility. Either you help to finance a current and maintain a current account deficit, or you cause the capital flight which you pretend to fight against. And in the end, you maintain the wrong price vector and the resulting current account deficits, as I said. How is it in America? You know that better. We have the ESA system. Here, just two graphs. This is the sum of the positive ESA balances in the United States relative to the GDP in the United States. And you know, in April, one has to hand over interest-bearing assets from one district Fed to another district Fed, which means a debt redemption. Here, in anticipation, the district Feds gave less refinancing credit, so that was a behavioral effect. Here, $190 billion were paid, and here again now, this is the latest data for this April, there is a redemption. So in America, this is not a problem, but here, see Europe. This is the European gross target debt relative to GDP. It's exploding because there is no gap. Europe has two choices. Either we go this way, that we leave the easy access to the printing press, target credit, then we need euro bonds to compensate for that. And in order for the countries not to abuse that, we need political debt constraints. That's the European way. I don't think it will ever work because these political debt constraints will not be open. And the other one is the American way. Liability of states, interest spreads, states can go bankrupt, and you have to settle the target balances. Thereby, it's not attractive to draw the credit out of the system. Of course, America has fiscal equalization schemes, so I don't want to be so harsh as not to offer any help. Here, I advise you to the EEAG report. This is a crisis-like procedure with liquidity help and sliced haircuts and so on, and Brady bond types of things, which I don't want to explain in detail. So my conclusion, we have a balance of payment crisis caused by current account imbalances, caused by the cheap credit in the initial years of the euro. The eurozone now has to rewind the clock. Some prices are too high, have to decline. We have to inflate in Germany. We don't want to inflate. The other countries don't want to cut their prices, so we are in a very, very difficult situation. I can imagine that the euro will not survive because of this problem. 900 billion target. ECB causes capital flight and maintains current account imbalances by its policies. The US model is better because it has harder budget constraints. Janos Kornai, 1980, predicted the fall of communism because of soft budget constraints. We should not make the same mistake of trying to run Europe without hard budget constraints. Thank you for your attention.